All right, everybody, welcome to CyberBulls. This is a weekly podcast that we do every Tuesday. It's all about Tesla and investing. And this week, we're seeing Tesla continue to rise, and we're going to find out all the good reasons why that is. Welcome to CyberBulls. Let's get started.
Tesla is the most consequential company in the world.
I'm just a bull on the EV business. I think the margins are going to explode.
Still the same company. Company is still executing.
The energy is bigger than the auto business.
I'm the young bull that talks a lot of smack.
All right, so welcome. This is the CyberBulls. You probably know, everybody knows Alexandra Mertz. She is what we call the Powerball because she makes things happen that helps Tesla, the stock. And she did it again. We're going to find out the backstory of how and why Moody's investment grade credit rating finally gave us investment grade. And she's going to share the whole story about why that actually matters. We've got Jeff Lutz, and he's the rational bull. When you listen to him, he speaks very rationally, but I don't always agree with what he says. And then we have Christian. He's our stoic bull. Now, he calls himself stoic, but actually when you listen to him, he's very passionate. He doesn't act stoic at all when it comes to Tesla and the economy. We're going to ask these two guys, what is going on with the economy? Is the banking crisis becoming better? Is that impacting the Tesla stock? And of course, we're going to also cover China numbers. It looks like that we're headed towards a record Q1 number. So welcome everybody. How are you guys doing? Are you guys pumped? Is this good?
A great day. Doing well.
Yeah. All right. Let's get started with, as always, the Tesla stock. I mean, we don't always do this, so let's go here. But basically, Gary Black said this morning, and he said that he thinks that the reason why Tesla's rallying today, number one, Moody's credit upgrade. Now, I know that I heard you say, Christian, that it's, that might just be a little bit of it. Mostly it's because the equity markets are higher. Everything is going up. Banking crisis is stabilizing, but also because of the China weekly insured numbers. So curious to hear from you three, which of these three do you think actually has the most impact? I'm sure all three does, but let's start with that conversation. Who wants to get started first?
I can jump in real quick. I think the China numbers for me were big. Now, of course, I think all three, me and Jeff were talking a little bit earlier, Tesla's melting up a little bit more than everything else. You got Google up 3%, you got the Qs up, pretty hefty, but Tesla's outperforming. And I think it is those China numbers, because remember, the reason around Tesla's decline, or there was a lot of reasons, but the main reason was weakness in China. What I think has happened is the price reductions in China is now coming through, and you could see through the numbers that they're eating market share again. And they're now, their domestic sales are starting to grow. I think this was maybe their second best week. I may be wrong, but you can see even in a bad macro, the demand starting to broaden out. And I think a lot has to do with the pricing power of the reduction. So for me, I love to see that number, and it makes me, more bullish than ever that Tesla could weather this storm.
Yeah, there's some information out there that's saying the demand for lithium carbonate may be, stagnating or declining. It could be some of, the plethora of EV manufacturers in China pulling back. And again, that's one thing I've talked about on this podcast is the stability in Tesla demand. They're continuing to put demand signals in quarter after quarter that are higher than the previous. And suppliers know when Tesla puts that signal in, they're going to get that business versus these end of quarter pullbacks. So I think the China numbers are big. They switched from, international shipments to domestic a few weeks ago, and they really ramped that up. And I think the Moody's upgrade is a big deal. I mean, I think Tesla melted up almost 8% today on a 1.5% Nasdaq. So that's a higher beta than normal. So I think there's a number of things happening, and it'd be great to get some momentum started. Of course, the macro side of this, which I think we'll get into more a little bit later, that could change things at a moment's notice. We have the Fed tomorrow. We've got, bank number, 6, who knows if it's waiting in the wings in terms of failure. So a number of things out there that could also get in the way.
Alexandra.
Yeah, well, I agree with that. I don't think Moody's is the main factor, but it is probably a factor, especially because we're getting close to quarter end, and some of the people that are now allowed to purchase Tesla may think, well, may as well do it as soon as possible. So we have them in because, all these funds, they report end of each quarter so that they have the numbers in by then. I think we'll have some good numbers when we see all these institutionals report by mid-April. So I'm quite happy. But I do agree. It was mainly the China numbers, and it was just absolutely a gorgeous day at the stock exchange. If you look at the whole board, it was nearly everywhere was green. So that is a good thing. Now, like Jeff said, tomorrow the Fed can spoil the whole fund. There is no doubt about it. This can go very quickly.
Okay, so let's go through each of these major topics: China numbers, the Fed and economy, and then Moody's. So first, the China numbers. So Rich Lowell Pritchard, we like him quite a bit, right, Alexandra? He always gives us great information.
Great.
So he said that the insured last week was 18,712 cars in China, a weekly record since late November. There we go. And then you can see the rise per week as we're going through here. Yeah. And then so he explained that in China, this January, he said here the best January ever, but then he clarified later that he actually misspoke. What he's saying is that this January was the best first month of any quarter ever. This February was the third best month of
any quarter.
The third best second month of ever. And March has the potential to beat 78,000, which is going to be the best month, the third month of every quarter ever. This quarter is going to have the highest probability of being the best quarter ever by a clear distance. So that was his explanation. So very, very big news in China. I just want to clarify. I think I heard you, Alexandra, say China was big. Jeff saying it too, but you kind of danced around, Christian. You didn't really tell me which one of these three are the biggest impact. You agree, right? Because in the chat, you kept you kept saying to me that, hey, every stock is up. That's what you said. I'm like,
well, let me put it like this: if the macro was down today and Google was down 2% and the Qs were down 3%, I don't think Tesla's up 7-8%. That's what I meant. I think the macro being up, a relief rally, or whatever you want to call it, and the Tesla Moody's news and the China news, and Tesla's been down more than every other big mega cap like Google. We're still down 50% off the highs, Herbert. So Apple's not down 50% off the highs. Google's not down 50% off their all-time high, but Tesla's still more than 50% down off its all-time high. So a little bit outsized beta is to be expected. But my main point was that I don't think Tesla's up this much if the Qs are down 2%. That was my point.
Yeah, and I want to temper just one thing. It's good that we see the numbers. It's good that we have all these cars sold, because that means we're gaining market share. I absolutely love that. We hear at the same time lots of rumors about BYD, which are not comforting their current strategy. But I also want to point out this is because they did those price cuts early in January, right? So when we had this discussion, was it right to do the price cuts? Should they have first tested marketing ads or whatever? It clearly shows now that it was necessary to cut the prices, and that's how they will expand their market share.
Yeah, did you guys see that not only the Tesla market share in China has skyrocketed and growing really well, but all the other Chinese car makers are failing. They've all fallen by 20%. There's rumors that we can cover later, just rumors. BYD factories have cut some shifts, and I can hear Jeff already saying, "Don't listen to those factories. Always readjust." You got it right, Jeff. You have to be fair. If you're going to say that for Tesla, you have to say that for BYD as well, right?
Yeah, it could be, but if it's a persistent thing. The other thing is when Tesla does their shutdowns, they do them for consecutive days in a row. And what we're hearing is that BYD is doing 4 on and 3 off, which is more of actually a trimming operation, like you're trimming labor versus you're shutting down for maintenance. You shut down for maintenance, you shut down for consecutive days. So who knows? We don't have any confirmation of what's happening here. I think all we can do is we can look at the Tesla numbers, we can look at the BYD numbers, and then we can look at the China macro numbers, and we can see that Tesla is having these consecutively better weeks while the China macro auto sales are actually lower. And so that means Tesla is taking market share. So that's what I think we should focus on.
Okay, let's take a question from Larry. I like him. We like Larry. So it says the biggest question for Q1 is margin. We agree. Did growing volumes in all plants, and most especially the new plants, more than offset the price cuts? It's a key question for Q1 and the next quarter, and the next. Yeah.
Yeah, it'll be more. It'll have to be more than growing volume. It would have to be targeted, event-driven actions from Tesla engineering, Tesla supply chain. And I don't believe in the first quarter they'll fully offset the price cuts. I think that would take a couple of quarters for them to do that. Of again, event-driven actions, of quarter-on-quarter takedowns. But yeah, the volumes up are going to help a little bit with the supply base. It's going to help a lot with factory utilization. But it's good. There would be a number of factors. I think they'll this may be the low point in recent gross margins in this quarter, and then steadily up from here.
Yeah, but don't you think, Jeff and Alexandra, that if Tesla, and we don't know where it's going to come in, but if they can get around this like 425 number after a 406 Q4 on a seasonally weak Q1, doesn't that instill a lot of confidence for the rest of the year, knowing quarter over quarter, we don't always quarter over quarter beat Q4. Recently we have. So I think that's a big, for confidence, I think that's a big deal. I
agree with you that, seeing a good number above 420 will be nice, just because it will be above expectation, but it's much more important what comes in the financials in the third week of April, just because we need to be reassured on those margins, which actually gets me to Moody's, because one of their criticisms on Tesla was that they expect the margin to fall to 15%. Now, they don't calculate the margin the same way we do. So they go from 18 to 15. So a 3% reduction, that's probably a better way to present it. And that's going to be the big unknown, right? How far are they with cost reductions in the production and supply chain, and how much did these price cuts hurt? So I'm all for having a good number beginning of April, but I'm actually much more excited if we have a good margin in end of April.
Okay,
yeah, okay. I wouldn't say that sounds like operating margin, and that could happen. Yeah, I think 18 to 15 could happen, but I think they ramp up from there.
Yeah, that's operating margin. 15% would be great. Well, yeah, I mean, we'd be decent, yeah.
Didn't they guide for 20% gross margins?
Yeah, that's gross.
Greater
they
than
were talking about operating.
Gross.
Yeah. So do we all agree that they're going to hit the 20% gross margin at the minimum?
I think they should come over 20, absolutely, yeah. I can't see them dropping that drastically in Q1. That's my opinion.
I don't want to play this sour grape, but I'm a bit careful.
You're careful?
Well, on the 20%.
Let's do it like this.
I mean,
well, let's do it like this, Alexandra. Now, I don't know if you have, what was the gross margin in Q4? I know we cut prices, but what was the gross margin in Q4? Wasn't it like 25?
22, right? 22, I think. I mean, I would have
around
to look at
25 net of credits, net of EV credits, I believe.
Right. So the question is, do we think we're going to drop down 500 basis points Q1? It could be. I mean, I don't know. But I mean, on the call, Zach was very clear that they were going to do more than 20%. If they were even close to that 20%, I don't think he would have made that statement. Now, maybe he gets it wrong, or maybe I'm reading it wrong, but that seeems pretty fine line to make that statement and not be sure of it.
They cut prices between 10 and 20%, right? So that's the revenue side. So I just want to be careful, because I prefer having a good surprise than a bad one.
Fair enough.
But let's wait, right? Let's just wait for them.
Okay, let's go back and visit Q1 numbers again later, but let's continue moving forward with the our important topic, which is the banking crisis that's happening right now. The Fed, I mean, Jeff and I swear, guys, you have to listen into the conversations going on. I'm getting like Jeff and Christian going crazy, and they hate the Fed, and they hate Powell, and I'm like, and then they do the right move, and then they're going, oh. They're not so bad, and then I hate them again.
Do the right move. I don't know when they did the right move lately.
Right. Okay. I'm not saying I love them. I'm not. Don't hurt me. I'm not saying. I'm just telling you what's going on. But okay, let's go through the list here. So, Unusual Whales reported that U.S. officials are studying ways to let the FDIC temporarily insure deposits beyond the current 250K without having to get approval from Congress. And so we got Elon responding to that, saying absolutely required to stop bank runs. So he's absolutely on top of that. Now he says also that the Fed needs to drop the rate by at least 50 basis points. And what's so funny?
No.
But this is ridiculous. I mean,
Yeah.
Why is
it
this
won't
funny?
happen. It won't
Well,
happen.
Elon said the same thing a few months ago. It's the same thing. They needed it. It's not going to happen.
You
So he
guys
can
are
say it all he
laughing at
wants.
Elon's comments?
Yeah.
Why are
Yeah,
you laughing at
we
Elon's
may.
comments?
We
It's not
laugh at
gonna
his
happen.
memes. We laugh at this comment. It's
Okay,
all
well,
okay.
let
No disrespect.
me provide context why I just said what I said. Is because there are people who said that, first of all, Elon has very good information. We all agree that he made the right calls when he thought that there was going to be a recession. He's been nailing it for even months before: inflation, deflation. Now he has tremendous amount of information. He knows about supplies and the prices and so forth. Some people are going, this is because Elon's very concerned. He's so adamant.
Which is completely possible, and I'm not laughing at that. I think his comment is probably very intelligent. That's not what I'm saying. But if he expects that his comment leads the Fed to lower the interest rate by 50 basis points, he's dreaming. That's not how they function. I wish they would, but that's not how it works.
Yeah, same thing. I'm not laughing at Elon's comment. I'm not saying he's even wrong. What I'm saying is, in relation to what I think the Fed will do, that comment does not jive. If anything, they're going to pause or go 25. If they cut, and they cut 50, I'm going to eat my words here. But if that happens, the stock market is going to go through the roof.
Ballistic,
But
yeah.
I digress.
Yeah.
I think it will. I don't think they'll be scared because the economy's doing okay. If you get a 50 basis point cut, that means the Fed is complete 180, and now monetary policy is getting easy. Credit becomes a little easy. Interest rates are going to go down. So I would see that as a positive, not as oh my God, the Fed knows something we don't, because they do not know something we don't.
Exactly.
Go ahead.
Yeah, I mean, he does have a good section of information. So, but there are a lot of inputs to the Fed in that decision that he may not have access to. So I think tomorrow, I would say if they were to cut tomorrow, that may get some mixed reactions. You may see the most volatile trading session you've seen, since COVID. If they actually cut tomorrow, I think that would be a huge surprise. So I think really tomorrow's going to come down to not the number that they release at noon Central, but the press conference that happens thereafter. I think that's what's going to set the tone for the markets.
The Q&A.
Based on Fed policy. The Q&A.
Yeah. So, Jeff, you said yesterday that you think that the Fed's going to increase by 25 basis points, but then they will say in the commentary that they're going to pause and they may actually reverse in the future. Do you still think that that's what's going to happen?
Yeah, I do think I think the commentary will be softer than, just here's a rate hike and, we still need to drive down inflation. The PPI data point, which is the producer price index, which is the lead in the CPI, was very encouraging. The CPI number was lower than the prior month, but not great. It wasn't great. There's still 6% inflation. But this bank event over 10 days ago now was probably worth 3 to 4 rate hikes in itself, in terms of what it did to people's psyche, their purchase patterns and behaviors in capital markets. So I think when you factor all those things together, that's why everybody's kind of floating in this band of 0.25 pause. Maybe they even cut. I think Nomura said that they're projecting a cut tomorrow. So that's why there's all this instability.
One thing I want to point out is this is not unusual. It's what it's called the mid-cycle adjustments. We're going to talk a little bit about it later, because I prepared some slides comparing it to 1994, but it happened as well in 2019 under Trump. You probably remember that. And then Trump really called Jerome whatever he was supposed to be called, and that stopped it. And then obviously COVID took over, and that was another story. But these mid-cycle adjustments, what we're currently feeling, this is not the first time. And actually, to his defense, Jerome Powell did a good study on the 1994 crisis. He talked about that when he did the 2019 adjustments. So I just hope he remembers what he was teaching then and preaching then. And I'm going to tell you a little bit more about it later on when we come to that chapter.
Yeah, and I want to just say real quick before we move on, this is great, but I just want to explain it to the audience because maybe not everyone understands or super sophisticated. The reason why Jeff's saying that this could be deflationary or it's like some rate hikes, it's because if these regional and small banks are worried about deposit runs, they're less likely to make loans, right? And a lot of the loan growth, car loans, a lot of it comes from these mid-sized banks, these regionals. So if they're scared to loan out money because they're worried about people wanting it back, on a bank run or something, they're going to be less likely to give loans, or they're only going to give loans to people that are really qualify for it, which will leave a lot of other people out, which will depress credit growth, which is essentially how our economy, we're 70%, I believe, consumer, growth. So that's why it's a big deal to stabilize the banks, because if they don't make loans, a lot of stuff seizes up. So I just wanted to kind of articulate that a little bit. Got it.
Okay. I just want to get back to this one. I want to hear you guys' real evaluation. You kind of laughed when I first said it, but
It's not going to happen, Herbert.
Oh, what? No, that's not whether it's going to happen or not. I want to explore whether or not Elon's saying this because he's concerned about the bank run. He's concerned about the economy. He's concerned about what could happen to society. Or is he doing this because of a selfish reason where he's looking at Tesla and the cars and the debts, car debt loans and so forth, and what's going to happen to Tesla's future? Some people are saying that that's why he's saying that he's very scared here when you hear this.
No, Herbert, let me jump in real quick, and then I'll shut up. We did this like 4 or 5 months ago. I don't know exactly. It was the same thing. Elon put up the thing, and you said the same thing to me. Is this going to happen? And I said, absolutely not. They're going to raise 75, not cut 50. And now here we are 5 months later doing the same thing. I don't know his motivation. All I'm saying is Tesla didn't fall off the cliff. The economy's still going. Elon's not, a super macro god. Yes, he's very smart and he has a lot of information. But the Fed, like Alexandra says, they're operating under a different set of rules. They're not looking at whatever Elon's looking at. So I'll be quiet. But this is deja vu for me with you. About 5 months ago. Yes, you said the same thing. He said it. He must know something, and that was like a long time ago. So same thing. Maybe something bad will happen, but yeah. So go ahead, Alexandra.
No, I completely agree with you. I don't think he does it out of any malicious reason, thinking, oh, I can buy a bank cheaper, or I can have easier financing for Tesla, which is a joke, of course. I don't think that's at all his thing. I think he's concerned. He's been concerned, but the Fed is just not going to listen. This is not the way they function. He may be right. Lowering the rates by 50 basis points may be the best thing that could happen to us now, but that's just, we can all scream for it, but that's not going to make it happen.
And I just want to caveat, he might be right and we all look like fools, but so be it. Like it might happen. So I'm not saying I'm so egotistical. I'm just putting that at like under 5% chance.
Yeah. You've always been telling us and teaching us, Christian, that it's all about investor investor sentiment and sentiment. Yeah. And so what a great way to actually stop any bank run, to get us back into track by doing a outsized move, not just what is expected. Because one of the questions I want to ask you guys is that let's go through the scenarios, right? So number one scenario is they do an actual 50 basis point raise, right? Cut. Oh. That clearly not going to happen. The stock market is going to go crazy because it's unexpected.
Right.
But if it's a pause, I don't think anybody's going to do anything. If it's a 25 basis point raise, I don't think anybody's going to do anything. And it's just going to sit there. And all the questions are still going to happen about, is the banks going to be safe? And what do you guys think? What might happen to the economy, but also to Tesla stock? Which is the best scenario for Tesla?
I think a 25
of course, the best
raise.
Scenario.
I'm sorry.
Exactly. No, go ahead, Jeff.
Go ahead, Jeff.
I was just going to, I think a 25 raise and then a little bit more dovish commentary in the Q&A would be appropriate for markets. I think that's what the markets are. I think if there was a zero raise, some people were even talking about a 0.1 raise. Like you could, but I think they're moving in quarter points.
Yeah.
So I think within a quarter point, I don't think people are too concerned about that. It's more of the commentary that occurs during the Q&A. Does the Fed get it? What happened? Like, is he gonna answer the question in the Q&A of like, you were just in front of Congress 2 weeks ago, and you were asked about the banks, and you said everything's in good shape, and 48 hours later, number 16 bank in the country failed, and now a week or 10 days later, we have basically five major bank failures around the world. What did you miss, and what are you doing differently going forward? I'd love to hear them answer that question in concert with, their Q&A.
Yeah.
Okay. All right. I think we've covered that. I'm sure it's going to come back up again in the conversation. Let's move on to the next major topic, which is Moody's investment grade credit rating. As we know, Alexandra has been incredibly important for S&P to give us finally investment grade credit rating in October. Unfortunately, it happened at the moment when obviously the economy was crashing, and then we saw kind of Tesla just continue to crash. And so it didn't show up yet, but we have been seeing in the last several months, as Alexandra's been pointing out, institutional firms have been buying and buying and buying. And so it did make a difference, and it's going to happen, as she has told us already, in over the 6 months to a year. That's how long it takes for a credit grade credit rating to happen, to actually impact a company's stock. But we finally got Moody's to upgrade Tesla's yesterday to Baa3. That's a rate. I don't know if you can see this, but basically it's boom. So Baa3, this is Moody's on the left side, and that's above the line where they consider it to be investment grade credit rating, right?
Yes.
So the question is this important? Is it not? As we just said, as we just talked about, we don't think it was important for the stock price today, but it is important. And so let's find out from Alexandra the story of why, what Moody's, how it matters. She actually worked at Moody's herself in the past. So this article was written, was it today? Yeah, March 20th? Yesterday.
It was yesterday evening.
Al Root. And he
Mm-hmm.
says, Moody's loves Tesla's finances. It finally upped its debt from junk. This is written in a Barron's article. And our very own Alexandra had a major big part in this story. And so we're going to hear that story, but go ahead and show me what you want to focus on here, Alexandra.
Sure. So this article was actually written when the story was over. But to let you know, we worked with Al, or I worked with Al last week on Friday. So if you maybe want to go 2 slides further where we see that table, that's probably the easiest way to start the story.
Ooh,
so you all now
this one?
go now further in the front. Yes, this one. So you don't need to make it big yet. I will talk all about it. So Moody's had done in January 2022 their last review, and I was telling everybody end of last year, wait for end of January. That's their annual date. They will come up with an upgrade then. Came end of January, nothing happened, and I was like very frustrated with myself. I hate not to be right? And so couple of weeks passed, and then one of my followers pointed out, did you see Moody's had published a credit opinion end of January? And I said, no, I didn't. Where did you see that? And so he gave me a link, and yes, there it was. So there was a credit opinion published on the 31st of January, as I anticipated. But these kind guys, I was close to it, but these kind guys didn't publish it publicly. They didn't make it available. They didn't publish that they left it unchanged, and the report was not accessible. So I checked it out. I could have purchased it for $250, and I have to tell you, I'm not at $250 close to my budget, but I really would have hated paying for it. So I sent a couple of DMs to people who are in finance, asked if anybody had it. No, don't have it. And finally, Gary, about a week ago, said, you know what, I'll get it for you. So he called around, and he sure enough got it for you. So thank you to Gary. So suddenly I had the Moody's credit opinion from end of January and read through it. And this table is off it. We're going to get into it in a second. It was just ridiculous. And it was very specifically ridiculous. So I thought a couple of days of how I would make this digestible, because, ratings, when you've not been in the industry, you just this blows your mind. You don't want to spend time into that. And then I was thinking, which journalist can I take on it? Because remember, my strategy middle of last year was just screaming it on Twitter as much as possible, and I had wonderful followers sending it out, retweeting it, whatever. But I mean, other than S&P didn't work, and with Moody's it didn't work. They answered to a couple of my emails, but then there was nothing anymore. So I said, this time we have to be more strategic about it. I have to find a first and then a second and third journalist with whom I can share some of the findings in then how ridiculous they are. I have to package it in a digestible way and then see what happens. So I had my lineup. Number 1 was going to be Al. Number 2 was going to be somebody else. Number 3 was going to be somebody else. And every time I wanted to leave a week in between it to make sure that this goes. Because what happens when a journalist has this information from us, they are obliged by deontology to call Moody's and ask them for comments and see, what their side of the story is. So by Friday I was ready. And Friday afternoon, I set up a call with Al and I said, I really want to show you something. And I showed him that table that I'm going to show you in a couple of minutes. And that's all it took. And he said, this is absolutely ridiculous. And I said, yes, it is. He said, you know what? I'm going to ask them. So he asked them for a first time on Friday, and he re-asked them on Sunday, and he re-asked them on Monday. And he says so in his article. So 3 times he contacted them and asked, what's this all about? This table doesn't make any sense. And so why does this table not make it? Yeah, maybe you want to show here. Exactly, there it is, where it says Barron's asked Moody's twice on Sunday and Monday before the Monday evening upgrade. So what happened is Barron reached out a second time, and they probably must have had fire under their chair. And don't forget, they also got all these bank ratings wrong, right? So they're having currently crisis after crisis, so they just threw the towel and upgraded. So what is this table all about? If you want to go 2 slides further, Herbert. So this table is there. Go ahead.
Before I get there, I do want to say that you did, like you said, you helped Al write this journal article, and then he did quote you in Barron's, which is really cool. Yeah. But really, you helped him make sure he understood the whole thing, which is great.
Yeah,
okay, so here's the table.
And I mean, that's how it usually works. I was in the rating industry. Whoever provides information to anybody always figures in an article one way or the other. That's the code between journalists. If they can name a source, they will let that source cite something so that they understand among themselves very well how to package that the other journalists get where it was coming from. And it's actually funny because the number 2 journalist on my list then reached out yesterday and said, the story's over. They upgraded. There's no point really making more out of it. So let's get into that table. If you can make it as big as possible, Herbert, I'm really sorry. It's so small written, but this is the scoring model. And I think I will actually tweet it later after this call because it's such a beauty. So this is their scoring model, right? So to rate an automobile manufacturer, the business profile gets a 40% weight, the profitability gets a 20% weight, the leverage and coverage gets another 30%, and then financial policy gets a 10% rate. And so for each of those, they do their numbers and then they compare it within the industry and whatever. If you can move a little bit more on the right. So as you can see, for each of these categories that are financial, which are actually the only objective ones, all the rest is just subjective how they feel about it. Tesla already got AAA in 6 categories. You see them here. So these are based on the financials of the last 12 months up to September. So obviously December was even better, right? So they didn't even bother include December. So those are those. And then the top ones are market share increase over the last 3 years. And for that, they gave them BA, A, and product breadth, different products. They gave them BA, which obviously is BS rather than BA. And then on the bottom, it's financial policy. And in financial policy, their only argument was that Elon is key man risk and Kimball is the brother of Elon and is on the board. That's why they gave them BA. So why do I tell all this? I tell all this because it's BS arguments that's the only thing that keeps Tesla from being a AAA, because they already acknowledge in this table that for everything that's measurable, like I do in my orange and green table every quarter, as you all know, they already acknowledge they're AAA. And then if you move to the right, it's the same table, but this time with the 12 to 18 months outlook.
Oh,
and
what's this?
And the same stuff. Okay. That's the same stuff, but now going 12 to 18 months forecasting. So the only thing that came down, as you can see, is this 18.8 margin to the 15.8 margin. That's a 3% drop I told you earlier because of the price cuts. So that one now suddenly became only a AA, but they still keep their crap of the BA levels for these three arguments. And so obviously, Al Root going there now twice or three times made them think it through a little bit quicker, and then they upgraded from BA to BAA, which is the slightest possible. What was even more important is to understand they already acknowledge on anything objective we're actually AAA. So I want this message to be out, and that's why I thought we should discuss it today, because I have enough time to explain it. But can you see how ridiculous it is? I mean, have you ever seen anything so stupid? It's just crazy.
So get right out to it. Why would they internally have this rating, but then externally they won't give the rating? Tell me
because
why.
they hate Elon and they hate Tesla, and they protect GM. There are a couple of things in there. So obviously anything that is Elon related is uncomfortable for this industry. I mean, they just can't phantom the guy. They don't understand what he's about. They don't understand his politics. They don't understand his language. They don't understand his vision. They don't understand anything. So that's the first one. The second is Tesla is disrupting so much, and so much of their own clients. GM is one of the primary clients of Moody's and S&P. GM has to maintain their investment grade rating. Otherwise, this whole thing explodes, right? That is their main food payer. That's the gravy train they live off. And so the fact that Tesla was still junk rated was a present to GM, right? Because their investors, they want to be in the automobile sector, and the only one that was up there as a US automobile sector in the investment grade was GM. And that has an impact. I hate that it has an impact, but it's just the way it is. I'm sorry, I'm throwing around
Alexandra,
my hands.
Yeah, Alexandra, but we've already established that Moody's is irrelevant. Even Elon, I mean, he's jokingly saying that, but they are irrelevant. We got S&P already. Is that true or not true?
I so wish it would be true. I mean, it was my former employer, but 20 years ago, the only thing I wish is they would just close and put the key under the door. But they are not irrelevant yet. There are still lots of funds depending on them, and not only pension funds, widow and orphan funds, and a lot of conservative people that are just used to this way. And the SEC is not doing their job. The SEC was mandated in 2010 by Congress to make them irrelevant, where 13 years later, they are still not irrelevant. And last year, they did an initiative to close them, and the initiative just died under the sofa. Nothing happened. So I wish they would be, and I really want to help to make them irrelevant, but at the moment, they are still what they are.
All right. This is why we call you the Power Bull. You're the Power Bull. But come on, keep telling us a story.
We call her something else now, the notorious Boomer Mama.
The notorious bull. She's a notorious bull. Well, actually, you are withholding some information that you didn't want to share quite yet. But okay, give me the history. Let's go with your charts here, huh?
Oh, you mean I'm talking about the mid-cycle adjustments now for the
You want to do that? Is this the right time?
Yeah, we can do that now. So just to put it in context, before we talked about anyway, I obviously had no clue that Moody's was happening yesterday. So in preparation of today, I said to Herbert, how about I take a chapter that's a little bit more history and governance and not only talking market. Herbert always says, go for it. He's just the best guy ever. And so I prepared a comparison to the mid-cycle adjustments that happened. Obviously, the 2019, I don't need to prepare. You all remember that one, but the 1994 one I thought was very relevant to compare to now. And so I prepared a couple of slides. And if you want to start playing the first one, I can tell you what I all thought about it. So this is meant to tell you where we are now compared to end of 1994, beginning of 1995. It always happens in spring. I have no clue why. And there we are. So to set the scene, we have Bill Clinton, now president. We have Alan Greenspan at the Fed, and the U.S. economy came out of quite turbulent 80s. The rate cuts then helped start, this economy to move up. You see the slide between 1990 and then coming down. And then in February, you can put the next one up then. On February 1st, Greenspan had the good idea to actually start raising rates too early. So this is a completely different situation than Powell, who started too late, but you'll see the result is the same. So Greenspan started too early in February by 25 basis points. Then mid-sessions between the February and the May session, in the middle of the session of when nobody was expecting it, he raised the rate another 25%. So everybody was, and the stock market reacted absolutely bizarre because nobody was expecting him to see so much inflation on the horizon to do this quite quickly. And then in the May session, they raised it by 50 basis point and another 50 basis point and another 50 basis point. So what is so comparable about it is that the steepness of the raises, right? That it came so quickly, and there we were. And so what happened then? Continue, please, Herbert, if you don't mind. So this is mon ami Bob Citron. So his name is Bob Citron, but I just have to call him Bob Citron. I mean, there is no way around it because he was just such a lemon, right? So who was he? So he was the treasurer of the Orange County Bank, which was a bank that refinanced lots of communities and whatever. So they put you can put the next slide up, Herbert. They put their money in this Orange County Bank fund, which pooled it all, leveraged it nearly 3 times. I mean, he was the goodies of all that. So the communities put the tax monies and whatever else money they had into this pool, and the pool then invested it, over leveraged it with, you guessed it, duration risk and signature risk. I think one of the best ones he had was a swap between Swedish krona and Swiss francs. I mean, no idea how he got that one, but he just took riskier and riskier stuff to pay back. And obviously, what always happens, look at SVB, look at all the regional banks now, is when you have a mismatch of duration and interest rates and currencies, and you have steep rate increases, that's where it all blows up. So the first one to blow up, end of 1994, was Orange County's bankruptcy. And just for the story, he was supposed to go 14 years to jail. He finally went 1 year, and he died 10 years ago. So Bob Citron is gone. But the story is really comparable. So what happened at the same time, the next slide, please, Herbert, is that the Mexican pesos, because that's why I'm saying there's always a couple of things happening at the same time. Like, no, I mean, what does Credit Suisse have to do with SVB, right? It just always happens at the same time. So the Mexican pesos had what is known as the tequila crisis. I mean, it just went through the roof. 3 months rate in Mexico went from 10% to 25% to 70% within 3 months. Absolutely crazy. And so we had this whole crisis in Mexico, which obviously triggered to all the neighboring states and whatever. So we had a couple of things that happened at the same time. And so what did the Fed do? So again, I just want to set the stage that this is very comparable to what we're currently living. So the Fed met, and they left the rates unchanged in February. So that was the first, or was it March? Yeah, February. Yeah, exactly. There you see it on the top. They raised it a last time between November and February by 25. Then they left them unchanged, and then they brought them down. Okay. And I just think what might happen might just look the same like this curve, right? We're nearly at the top there. We may see the last 25 basis points to that peak that they did then, and then see it relaxing. And why do I feel so strong about it? Because when Powell in 2019 tried to do the same thing, he said, I am copying the mid-cycle adjustment of 1994. And so I do believe he knows very well what this is all about. And then the last slide I prepared, if I remember right. Yeah, oh, there are 2 more. So this one I found was an interesting slide, which actually goes up to now, because you see in black, the Fed rate, and you see in the colors the different maturities of treasury bills, right? Up to the 30-year bonds. And you see how these sometimes expand to a lot, where you have a normal yield curve with higher rates in the 30 years, and you have some other periods where they contract a lot and they just sit around this. So you see the 1994 in about the first 20% here. Yes, exactly here that is. You see it's contracted, right? And that is a sign when you have this contracted or even inverse yield curve that something, there are powers pulling each other in different directions. And you see the same happening again now. So I just wanted to put this one out because I found it was a good illustration. It shows graphically quite well how this is happening. And then to relax everybody is the last slide. I'm sorry I'm talking so much today, which is the stock exchange. So I have in red here what, the period I just talked about, and then you see what happened after that. And I just thought it would make you all happy to see that.
Yeah,
so there
up and to the right. That was great, Alexandra. And I'll just say for the audience, that was well done. But like, see how we have press conferences and it's kind of telegraphed. Back then, they didn't have any of that. So Greenspan, we had no clue what these Fed chiefs would do, whether they would cut, whether they wouldn't. They used to, yeah. The briefcase indicator, how fat was the briefcase would determine if he was going to raise or not. It was crazy. This is actually much more like telegraphed than it was back then. But that was a great presentation and a great ending. So hopefully we'll have a similar outcome. Yeah.
Good. I'm glad you liked it. And I'm sorry I'm talking so much, but like I said, I prepared this on Sunday and then here we go. We got the Moody's upgrades. So there we go.
What is your opinion about Greenspan versus Powell? Because the three of you really don't like Powell. And what do you guys think about Greenspan versus Powell?
I didn't like Bernanke either. I like none of them.
Yeah.
I think you're just all whoever it is there, you're going to just insult.
Greenspan was considered the guru. Yeah, Greenspan was considered the guru of like Fed chiefs because he was the one that said irrational exuberance. He ushered in. He presided for a long time under a pretty good market. So he was considered like the dean. Powell to me seems like, I don't know. He seems like kind of a deer in the headlights. I like the guy. I think his heart's in the right spot, but I don't think he quite grasps moving pieces. He fixates on one thing and then he just does it. He did the same thing in 2018. I'm raising rates, and he made a blurb, we're nowhere near neutral. And that freaked the market out. What do you mean you're nowhere neutral? We're just going to keep hiking until oblivion? So he makes a lot of missteps with his words sometimes. And I just don't feel the confidence from him. And I just want to say this real quick. I don't want to be a pessimist, but here's the downside scenario. Jay Powell is on this inflation kick again, and he gets up there tomorrow and he does his 25 and he sounds hawkish again. Inflation's still too high. The economy's still doing well. There's still a tight labor market. And he doesn't really acknowledge the broader bank crisis. And he keeps focusing on inflation as his number one thing. And he ignores everything. I think that would freak the market out because it's going to give the signal, no, we got more work to do. I'm focused on, I'm not saying he's going to do this, but I'm saying this would be the downside where he focuses on that and he gives very little dovishness to the banking crisis, like Jeff said earlier, which is a deflationary event. So that's my worry. So the commentary will be key. And if he does that, look down below. So anyway.
Yeah, I was concerned because a lot of people were saying his dovishness will be based on how the market trades, 2 or 3 days in advance of the meeting up until the meeting. I'm like, I hope not. I hope there's real, like with the 400 PhDs, I hope they're literally cranking out charts and data left and right, and they're really trying to nail this. And that's been my problem. I don't think I have a personal issue with Fed chairman. I have an issue with their tools and the fact that they're not advancing at the pace of our economy and at the pace of how data and information changes. So when a kind of a forward-looking visionary Fed chairman or woman is put in place, and they actually develop those tools, and they give the presentation that Alexander just gave us. They give us a kind of a presentation of this is what we're doing to be more predictive and more accurate. And we've applied these models, and this is what it would have done if we applied these models in retrospect. I'd feel a whole lot better.
I agree with you, but I don't really have a problem either with the chairperson, because obviously they are incarnating all the rest, so the hate goes to them. But, and I'm sorry, we're getting a really bad storm, that's why it's getting so dark here. But for me, it's more the 400 PhDs behind it, the data they're working with. It drives me crazy. When we had a couple of months, Katie Wood writing a letter to the Fed, I just thought, my God, I mean, I know she will never become a Fed person, but she would take this completely differently. And I don't agree with everything Katie Wood does, but I think it needs somebody who has been in the economy, who has run a business, who understands where this comes from, who has done a completely different market-oriented analysis. The Fed rate shouldn't just be about the stock market. I'm the first one to acknowledge that. But what they are currently doing is just, they don't speak our language and they don't see our world. They just don't.
Yeah.
Sounds
And
like
to
you
give a
guys
little
are-
bit, oh, go ahead, Herbert.
Oh, sounds like you guys are all talking about Elon. Should Elon be Fed?
No, I
Yeah,
should be
doesn't have
Fed
to do-
chair. No, just kidding.
Christian's
Weren't
the
you
Fed
running-
chair.
quick,
weren't
though,
you running
Bernanke,
for
look-
president? Wait. Let
Yeah,
me tell
president.
everybody.
I'm going to be very busy. Anyway, so Bernanke, and I got to give Jim Cramer credit here. Now, everyone makes fun of Jim Cramer. I'm not saying as a stock picker. When we had the crisis, he did a rant. And guess what? It was one of the greatest rants ever. He said, Bernanke's got to call someone. This is like before the crisis. Bear Stearns' worst bond market ever. Call someone. People are calling me saying this is getting really out of control. And the Fed was asleep again. They had people saying we got to keep going higher. And there was we saw the crisis unfold. And they didn't even mention it. It was like, everything's great. And he's like, call someone. And that's what I think Powell needs to do. Call Elon. Call whoever you want. Like, there's a world out there outside of your, 400 PhDs that are moving numbers around. We have, banks that are closing. We got European banks in trouble. We got, we just got all this stuff going on. And you have to take that into consideration. You can't just look at a lagging inflation indicator and not try to make some assumptions moving forward that inflation will come down and I have to stabilize the economy and the banking sector, right? If you don't have a strong banks in this country, we're going to have a disaster. The 1929 was a bank run, right? What happened in the Great Depression? It was essentially the banks were doing bad things, literally taking the money of investors, depositors that they thought were safe, and investing in the stock market. And when the stock market went belly up, everybody that had money in the bank lost all their money. And then they lost their job. And that's why you had this vicious cycle. So I hope, please, Chairman Powell, if you're listening, please understand that the banks are more important than getting inflation down and egg prices down a few months earlier than you wanted.
Completely
So,
agree.
yeah.
Completely agree. What really brings any economy worldwide down is a bank run. No matter what country you tell me, anywhere, in Europe, in China, in the United States, in South America, anywhere. If you have a bank run, you can Google bank runs. They brings the economy to its knees. There is no doubt about it. This is much more serious than they want to admit. And while I was always saying, the Credit Suisse story, that was waiting for it for 20 years. There was initially three big Swiss banks: USB, UBS, and Credit Suisse, and it was just predictable that they would end up being in one. But that's not the big thing. The big thing is that if you lose confidence of the people having money on their checkings and savings account, the whole economy will go down. So that's what they have to address this week, whether he wants it or not.
This is why when Elon says raise it by 50 basis
just
points,
Cut it. Not raise
what
it.
he
Not raise
no,
it. Cut it.
if they cut the interest rates by 50 basis points, it's going to fix the issue of banks when their balance sheet and all that's going on. You just said, Alexandra, the bank run is the biggest problem. And if you follow this through, people have not lost their jobs other than technology, tech and finance. It hasn't spread out there. So this is a very different kind of recession we're headed into. And so if they solve the bank run, there's no bank run.
No,
I guess the part I
But
want to ask you guys is
Herbert, employment's the lagging indicator. That's the last thing to go.
Yeah.
So you can't wait till we see 100,000 negative jobs on a print. Oh, the next month, 200,000. It's too late. It's already in motion. If you want to stop it, you have to play a little bit of prevention and say, hey, we've already gone too far. Let's just chill. Right, but what I'm saying is, yes, but they're not going to, because they just talked about how they were going to increase 50. So if they cut 50, they're going to look like complete morons. And I don't think we need to cut 50.
What you look like. You need to stop the bank run, which happened this weekend. Okay, so they got to stop.
Especially, and Christian, the thing is that A bank run 20 years ago or 30 years ago, you said it very well, didn't have at all the same infrastructure of information. Now, one name is popped on Twitter and everybody worries for their money.
Yeah.
I remember my situation about 10 days ago when suddenly Wells Fargo was not showing my bank accounts. Remember the four of us were discussing it. And then I think it was Jeff who had a problem with his bank as well. And we were all getting very quickly, and you know, it was a matter of a couple of minutes getting nervous. Yeah. That never happened before. So, and I don't think those guys from the Fed know about that. I don't think they understand how quickly information runs now and how quickly people want to move their money. In the good old times, you would have to go to the bank and you would have to go there with your bag and pull cash. Now you know, I mean, I don't know you, but I opened this week another bank account at another bank, just making sure it wasn't Bank of America. I can tell you that one as well. So I was making sure that if I needed to, I just could move everything that was above the 250,000 until it is guaranteed that they're going to go for everybody above the 250,000.
Yeah.
Why do you have money above 250,000?
Yeah.
Should be Tesla.
Just to answer your point real quick.
This is my business.
What I'm saying is that they can avert bank runs and panicking the market by two ways. They could either pause or they could do the 25, get up to 5 on the Fed funds. So they're fighting inflation. We still do have high inflation. So, and it's a little bit of dovish commentary. So what I'm saying to you is a 50 basis point cut is not necessary to stop bank runs. All they need to do is either go 25 or pause and just acknowledge that they are working on bank runs and they are cognizant of the fact that there are some cracks in the banking system and they are addressing it and they are well aware of it. That will be enough to sway everyone.
Yeah.
What do you guys think about this comment? I was just thinking exact same thing. So when everybody said Tesla's not somebody had a very good term you guys used last week, which is what was the term used?
Safe
Tesla's
haven.
Not a safe haven. No. Yeah. So Tesla's not seen as a safe haven. But in this environment, right? Okay, of course the world can crash. I'm not saying it cannot, and we got to be careful of that. But if it stays the same, we're doing okay. Tesla, this is Tesla in a bad macro environment. If there's any hint of a pivot, which I've been waiting for, because we are in a growth stock, Tesla will start to run. It should run because it's kind of that last to fall, first to rise, strong balance sheet, great strategy, all that's ready to go. It's being held back because of the macro, primarily because of the macro. Everybody kept telling me it's the macro, correct? There's nothing else but the macro.
Well, there was other things, but macro is a big one.
It's the biggest.
Yeah, and now I'm starting to worry about the macro auto industry. I mean, you've seen these notifications now from GM, right? First off, they had the involuntary severance last month, then the voluntary severance announced 2 weeks ago, and then 2 plants have been shut down for inventory and quote unquote supply concerns. And you have to wonder, what are these auto interest rates doing to the auto industry? And there's 3 million auto workers attached to the auto industry, whether they're in auto plants or they're suppliers or periphery companies to auto plants. So that has to be studied a little bit more closely. I'm not sure what's happening there, but if you just go off of the statements and you go off you just see the increasing inventory quarter on quarter, and you see what these companies are doing in terms of slowing and stopping factories and laying off big chunks of their workforce, there is cause for a little bit of concern.
Or they're even more than a little bit, even more than a little bit. I posted about that last week, Jeff. I think we had that discussion. I mean, for them, it's coming from all sides, right? And that's why that GM rating is such a thorn in my eye, because they have obviously issues with the worth of their factories compared to the book value of their factories. They have a problem with the worth of the cars that they have lended against, both for leasings and for financing. They have a problem with their EV production. They have a problem with their workforce. I mean, we see them laying off people now. It's just coming from all sides. And let's not even talk about their franchisees. I mean, their franchisees are not going to go without a fight. They have most times 10-year contracts there with a certain promise from the automaker. They put a lot of money on the line, and they're not just going to go away because GM suddenly changes of strategy. So believe me, for them, it's closing in.
Yeah, you've been warning about this, right? This comment here, the auto loan and financing side of old auto. Do you want to just repeat that? Because you've been saying, watch out for this. This is coming.
Sure, because they're running into a problem which is not even for all their own fault. You all remember during the COVID years how the cars were expensive, right? So they lended against an expensive car price. Now those used cars are not worth what they are depreciating linearly. So either they get the cars back after 2, 3, 4 years of lease, or now that we see so many more repossessions, they get the car back because they are repossessed, and they don't have the book value that they have in their books. So they have actually the same gap that we see at the banks, right? When the banks didn't do the mark to market of their bond portfolios, it's the same problem. So they're gonna really run into this under coverage for their assets. They're gonna have to depreciate a lot more, and I don't know how their audit people are going to look at that, because this is now significantly enough for them to have to do provisions about it.
Yeah, and even as Tesla is, EV as a percent of total auto continue to grow. I think in North America it was 50% growth year on year, and in China it was 100% growth year on year in terms of the percent of EV shipped of total auto. So total auto can come down as long as EV as a percent of auto continues to outstrip that reduction in total auto. Tesla's in great shape. They have the supply, but the problem is in the news cycle, Tesla will, if there's a broader auto slowdown being discussed, Tesla will get swept into that momentarily for some period of time, and then it's going to be up to Tesla to tell that story, whether it's waiting for P&D, whether it's waiting for guidance, or preferably even more often kind of saying, like, look, we have more demand than we know how to deal with. And you see what we're doing with our factories. We're consistently expanding our factories. So we don't have an issue. We don't see an issue. We see what's going on with others. But I think momentarily, if there's a broader auto slowdown, they could get swept up into that for a period of time. So that's something to keep an eye on.
Yeah.
Okay. So next month at this time, April 20th or something like that, we're going to see the Q1 results, right? Tesla's going to report their Q1 earnings. And in between that, is there anything that's going to happen to the stock? Is there any kind of news that might come out?
Oh, yeah. I mean, first of all, we have beginning of April, the numbers, right? The delivery numbers. We will also have, exactly. We will also have latest by April 6th, the proxy agenda for the shareholder meeting on May 16th. So there may be some real nuggets in there. And I mean, I think we will see actually a quite positive move in the next couple of weeks. We've been beaten down. I say everybody all the time, for me, this stock is today worth 300. So, I know this is not financial advice, but we've got way to go to be at the level we should be.
You're just saying that because you have call options expiring in April.
I do. It's actually funny because I remember when I bought them a long time ago, and I was with Larry discussing it, and Larry said, you should not do that. And every time I look at these options, I'm going like, oh my God, Larry told me to not do them. But I may actually get close to in the money now. I'm pleased. So I've got $200 for, I think it's April 21st, if I remember right. And then we'll see. And it's tiny little thing. But if I can get out of that, I would be happy.
If Xander was here, he would have recommended to you, if you did a call option, to do it at least the month after the April 20th earnings call.
He's so much better than me. I know. Yeah. This was gambling, no doubt.
Oh, okay. So you guys think good things are going to happen to Tesla as we move forward. Just another quick bit of news I think I cannot ignore, which is, this is breaking news, but actually it's just an insider who told them. We don't know how true this is, but they have expectation of what will actually happen to the revised Model 3, which is codenamed Project Highland. Let me just go through it very quickly. And so what they're saying here is that there's going to be redesigned headlights, and that's it. Just going to be brand new headlights. And so that's why they're covering the front. There's other, not only because of the headlights, but there's actually going to be another camera right down below here, right here. So they said that there's going to be a camera just like you see here in the Cybertruck right here. I don't know if you can see this right here. Front fender, the front bumper, they're going to do something fairly similar. So that's going to be 3 new cameras for the Tesla Model 3, which is answering everybody's concern. The one will be in front and the 2 extra on the repeater sides. The rear bumper is also changing, but nothing new, just a new change maybe to cut costs. The mirrors are going to change, but again, very minor, and additional cameras. I just mentioned that. So 3 new cameras, 1 in the front and 2 in the repeaters. Additional sensors, nothing here to, they don't have much to explain here. And then interior as well, but again, very minor, just to improve things a little bit better. So that's what we are seeing. Again, it's from an insider, so we don't know how true this is, but I guess what's not talked about here would be cost reduction. Cost reduction. So I'm fully expecting that Project Highland with the revised Model 3, it's going to have significant cost reductions. Okay, a significant cost reduction. It might have the front and rear casting. And so I've been hammering this, that I think that there's actually no need, not that there's no need, but it's not important to be talking about the Model 2, this $25,000 car. I think you could take the Model 3 and reduce it by another $5,000, and then your total addressable market skyrockets at that point. What do you guys think is a chance that the Model 3 will have further price cuts, maintaining the margin that we all want to continue for the year?
I mean, I think you're right on Model 3, right? Go ahead, Jeff.
No, please go ahead.
So I think you're right on Model 3 being able to have price cuts, but I can't believe we have this discussion again, Herbert. I mean, I know you love your Model 3. I know you love it, but there are big ladies like me, right? And they hate the Model 3 just because we need space and we're going shopping and we need a car with whom we don't have the feeling we're ditching down into a Porsche every time we have to get in and out. So I still believe the Model 3 is not the only mass market car in that price category that we need.
Can I respond to that, Jeff? I'm sorry.
Sure.
The reason I want to respond to it is that if you see what happened to Tesla segments, they screwed up. The Model Y took over and just obliterated. It became the number one. And Model 3 is not selling as much as they thought it should sell. So they need to differentiate between a Model Y and Model 3. There is a place for the Model 3 and there is a place for a compact car. They need to redefine the Model 3 a certain price point so that they'll sell more Model 3s. That's why I'm saying this.
Yeah, and you're right.
Yeah, look, I mean, yeah, that line has been down for over a year. And I believe they're doing significant design changes, quote unquote, under the hood in the manufacturing process. And I believe this is how Tesla, if you're trying to analyze, as an analyst, if you're trying to analyze Tesla gross margins and you're doing some, flat linear decline on, in MSRPs, you can see the changes. If you're doing some flat linear decline on their cost structure, you're looking at it the wrong way. I believe they're going to approach it, in 3 ways. One is through volume. They're going to get the reductions. 2 are these event-driven actions on existing models. And 3, what they're doing with the Model 3 here is they're going to upgrade the car. They're going to upgrade its capability while they're taking its cost structure down and introduce it as a new lower SKU. And they're going to do it in many ways that we can't see as consumers. But the fact that line's been down that long, I think they're doing some fairly significant things from a manufacturing perspective that are going to land that. And I believe an all-wheel drive Model Y, kind of a standard range car where they can also take some cost out, and they'll get that up in volume as well out of Austin. So I think Tesla is going to not only take the cost structure down their existing models, but they're going to introduce models at new price points to help their overall gross margin. I think Model 3 is a winner if you can take your cost structure down, $5,000, $6,000 or more. That by the way, that is significant. That is significant from a cost structure perspective, and I think it's a winner. But let's see what they introduce.
Can you answer this question, Jeff? What line has been down for over a year?
I mean, the Fremont, the long range Model 3 line's been down for I think it's been a year.
Okay.
So reintroducing the long range version of the Model 3 in this new cost reduced format, and then cutting over the other models potentially. I think that could be a significant move. And again, I think they're really changing the manufacturing process on that line. And we know money is being spent. We know new capital is going into Fremont. They're not just keeping that factory status quo. They are making changes, significant ones.
So explain this to me, Jeff, because I have no clue about manufacturing. So I mean, I know they took the Model 3 long range off the offer, right? You couldn't order it. I actually have one still that's about a year and a half old, and I think that must have been one of the last ones that came out. So what happens in manufacturing? So you have a line that produces the Model 3 long range. They take that off the offer. That means that line is now not used for Model 3 performance.
They could have multiple lines. We just know I should state that long range SKU has been taken offline for over a year.
Yes.
They may have obviously there's other versions of the Model 3 that are being produced and shipped out of Fremont continuously.
Exactly.
But the Model 3 you have, and the way that Model 3 was constructed, that has the greater than 70 housing parts in the body mechanics. So if they're going to go to a structural design on the body, for example, that's going to take a third of the robots off the line. That's going to take significant. You're just you're erasing parts and process steps from the product. So that's how you take the cost structure down. They may have several other changes that just we're not aware of that they can implement. And again, Tesla has these rolling. Tesla's introducing changes every few weeks, regardless. But if you have the ability to actually take the product line down, take the actual manufacturing line down per se, and then and relaunch it, you can do a lot more significant changes, I should say.
And cost reductions. I understand. Just for the little story, so I have a Model 3 and the Model X, and the Model X had an update yesterday. I don't have FSD, so that wasn't the update. And then when I got into it this morning, it now has a heated yoke steering wheel. I didn't even know. I mean, obviously the hardware must have been there. You can't do that just by an OTA, but they activated it overnight in that update, and that was really a nice surprise.
Yeah.
All right. One last topic, if we can. So I think the three of us, actually maybe all four of us, were on a Twitter space, and we had a investment person who has money that he invests, and he is more of a bear for Tesla, specifically in the next 3-6 months. And he was saying that he does not expect Tesla stock to do anything for the next fall, this entire year, 2023. What was your reaction when you heard him say that?
That'll mean it'll skyrocket.
Was it Jim Cramer? When
the bears get more bearish, the stock usually goes the other way. I don't know. I don't remember exactly, but I'll just go high level. So, look, 2023 has already been a good year. If you just go year to date, right? We had a major crash. So year to date, we look good, right? So it depends how far you're going back. But now the question is, can we rally into year end? So I think it really does depend on the Fed. And I talked about this last week, right? It's very hard to get sustained rallies and hit all-time highs eventually in multi-year bull runs if you have the Fed fighting against you. So tomorrow's a big day because the Fed is going to set the agenda essentially for the next few meetings. Now they're going to say data dependent and all that, but if they just kind of give us a dovish thing saying, look, we've done a lot on inflation, we think it's going to come down, and we're going to turn a little bit and make sure the banking crisis and jobs or the economy, doesn't go into a recession. We're actively going to try to do our dual mandate. I think that'll go a long way for confidence. So, and I'll just end it on this. But I do think that Tesla's business itself, and I've been saying this, in a tough macro, I think Tesla, the business, will do fine. So I think the stock will hold up well. Barring anything like Elon selling or craziness coming out of the woodwork, if you just focus on the business, I think they'll be fine because the valuations come in from the all-time highs where we're not trading at some ridiculous thing. We're literally trading. I think we're still under a 50 PE on a trailing basis. So if we do grow, I think, we can go higher as long as we don't have any major collapse, a major recession. I think we'll be fine.
I have a question to Jeff because he got the FSD version 11. Do you think this is going to be something that will finally trigger through to the stock market, or is it still too early?
I think it's going to take a little bit of time. I think it's only upgraded to a few users, but I will tell you, on like for like streets that I've driven on, with prior releases to this one, it is noticeably better, and it's significantly better. So when you extrapolate that across a larger population, I think that's going to drive more uptake on FSD. Is it a release that's a kind of a milestone release? Probably not a milestone release in terms of like this unlocks, this in pricing, or this unlocks, I don't think it's that. But it's a significant. I mean, we've gone a couple of months from having a major release, and it has been driving for me significantly better than the prior release, and I've now gone on a couple of drives with it and gotten much better results. It's just more confident. To be specific, it stays in the center of the lane. The turns aren't as rugged. They turn like, it drives more and more like a human. The acceleration, the deacceleration just feels great. So again, there's more work to do. It's not perfect. In fact, I had one disengagement and a little notice popped up and it says, "Hey, you had a disengagement. Why don't you record a quick voice note for us and tell us what happened?" So I thought that was cool. I think it's just, they're going to accelerate, bug closure. But I do think this was a big step forward.
Good.
Yeah, that's a good story. And real quick, and I don't know, Jeff, this is to everyone, Jeff, Herbert, Alexandra. I've noticed on Twitter, there's a couple bears. I don't know if you got follow any Tesla Bears account. They've actually been quite impressed with Tesla deliveries. And like, I've seen, they're like, wow, they're moving some metal, right? Even in this tough macro, I see some bearish people on Tesla really impressed with what Tesla is doing in this tough environment compared to what you see Legacy doing. So I think there's slowly some, reimagining of what Tesla could do this year, that it's not going to be some demand cliff, but it's going to be actually pretty strong. I do see that little bit of a pivot in their thinking about how Tesla is doing. So I don't know if you guys picked up on that.
Oh, yeah. I mean, every single issue that they hit Tesla with is going away. So number one was China demand.
Right.
And then Elon comes up and says, there is no issue with China demand. It's battery constraints. There is no issue with battery constraints. There's Tesla, is Twitter, his purchase of Twitter. Well, Twitter is now right-sided, and we believe that it's on its path to cash break even. And so now he's making, obviously creating chaos. He's still doing that, but he's softened a little bit in the last 2 months, as we all have said. But it doesn't matter. Even if he continues doing it, people are just getting used to his comments at this point.
Right.
It's not as making it a big issue. People are warning us that next year is a political year. And so, yes, that is, I can see that that's going to be an issue. But everything that has hit Tesla is gone except for macro. And so if macro turns, and this is the thing we said, right? It fell from 300 to 100 in a matter of 3 months, September, October, November, December. And so it's going to rise back up to 300, buddy. It's going to rise back up to 300.
Let me just say this. We're all
Listen
bulls,
to me.
I know. All right. I hope you're right. But we're all bulls. But I got to say this, and I'm going to say this way ahead of time. I love Elon, and we do have a political season coming up. The fundamentals of the business is taking full stage now, because a lot of the chaos we were talking about is kind of dissipating. Let that be. Let the fundamentals of Tesla. Let him talk about Tesla. If we get back into this rabbit hole of whatever Elon's doing and it's controversial and politics, I'm just saying, in my humble opinion, I don't think it's good for the stock price, because what will happen is you'll get distracted. CNBC will run stories, and the fundamentals of the business will get pushed to the side, and that will become less of a story. And Elon will take. I'm just telling you now. Telling you now.
I know, but come on, that's what people were saying. People were saying that 2 months ago, and then finally we got data. We got data.
Got obliterated.
But we got data. We got data saying.
Don't act amnesia, Herbert. We just had a 75% decline. The stock got obliterated.
The stock got obliterated because of macro. Because of China, the numbers. It was not as people thought. Because of Elon's craziness. I was part of that whole thing. But the data finally came back and said that people are not as they weren't making decisions. Now it could be just still the people who are loving Tesla, right? There's still a huge market there, we got to wait and see as it grows beyond
we'll
2 million
see.
a
Maybe
year.
I'm
At this
wrong.
point,
You've changed your
at this
tune.
point,
You used to be concerned about Elon's politics.
Exactly.
Now you don't give two craps. Yeah.
Exactly. There you go. I changed my tune because I have seen data. Okay.
But what I'm saying is the data will get pushed to the side if Elon becomes the distraction
No.
again, and he
He's
talks
already a
about the
distraction.
political. Yeah, but
All right.
okay, I won't say anymore. I won't say anymore.
You're right.
Herbert,
You're
just
probably
tell us
right.
what the price is going to be tomorrow, so we know.
Well, first of all, I've done not so bad predicting whether it's going to be green or red. But no, I've not done.
I've been better predicting the stock price than you, Herbert.
Yes,
for sure.
Yeah. You're my master. I bow to you. I've learned a lot.
No, I'm
You're
just
my
saying,
mentor.
look, I'm not trying to end the show on a bad note. All I'm saying is, and I've talked about this and been very blunt, all I'm saying is I would love for Tesla to be the spotlight. I would love the business fundamentals to be the spotlight. And Elon can say whatever he wants. I just don't want him to make political enemies unnecessarily. I'm not asking for too much. That's it.
Did you not see Investor Day, entire 4 hours about the fundamentals of the business? Okay.
Yes, but Investor Day and all the fundamentals of the business will go by the wayside if CNBC runs 24/7. What Elon's
They're
tweeting.
doing it now. They're doing it now.
No, they haven't been doing it as much. CNBC's been more fairly covered, I think. What do you think, Jeff? Before we end, do you think CNBC's given a little bit better coverage? I watch it. I think it has. But maybe I'm wrong. I
think it's kind of a world's
Hit or miss.
tallest midget. Yeah, it's kind of like I don't know how else to describe it. So
mixed bag.
Yeah. I mean, there's less for them to pick on, but
there's less.
They're also selectively just not reporting. Like I haven't seen anything
But
about
that's
the China numbers.
Don't say
I haven't seen anything about. So anyway, that could be a whole show.
And they
itself.
they still favor the advertisers. There's no doubt about it. There's so much smoothing around. Ugh, it's disgusting.
Yeah.
Okay, stock price prediction tomorrow. It'll break 200.
It will.
It all depends on the Fed. Oh wait, we should do our little Fed round table and wrap it up. Who wants to go first? Me?
Okay,
Yeah,
I can go first. I think it will be unchanged, and he will still talk too much about inflation in his press conference.
Okay. Go ahead, Jeff.
25 and pause.
I'm going to go 25 and pause, and also slightly dovish because he's going to cater a little bit to the banking crisis, and he's going to massage us a little bit there. That's my opinion.
I think they're going to have to pause. They cannot do 25. They have to pause. Banking crisis matters the most. I'm going to be right. They're going to pause, break over 200. All right, guys, this is the Bulls.
Yeah,
thank you very much.
That we do a roundtable tomorrow after the Fed press conference, right?
Right. So correct. So after the Fed conference, please tune in again to Brighter with Herbert. We're going to have another show. Normally, Alexandra will be there, but we're going to have the other Bulls join us as well. So other than tomorrow at 12 noon or right after the Feds do their talk, please join us for CyberBulls every week on Tuesdays. And we're going to get a little bit more lively than we have been. And this was lively. Thanks,
we're going to do tomorrow? Oh, that's going to be fun. I would love to jump on tomorrow and get my views. Yeah.
Let me okay, watch this. I'm going to shut Christian down. Watch this. Go.